In order to start trading, you need to open a trading account with a stockbroker in your country. The stockbroker would guide you on the formalities that you need to complete so that a trading account can be set up for you. Once this trading account is set up, you need to transfer funds to your account so that you can start trading. If you would like to start trading, you should also broadly understand how your trade is executed. A typical trade life cycle consists of certain steps. The first step is trade order initiation. In this stage, you will place an order with the broker. You will decide on the price at which you want to buy the security. You will also decide the quantity, that is the number of stocks or shares you would want to buy. Depending on your preference, you will place a market order or a limit order. We will look at the details around order types a little later. The next step in the process is risk management and order routing. The broker is responsible to ensure that the client does not default on his trade. So if you are buying a stock, the broker will check if you have the required amount of cash in your account. If you are selling a stock, the broker will check if you have the required number of securities in your account. Once he verifies that you have the cash or the securities, he will pass on your trade to the exchange. At the same time, he will lock in the funds and securities in your account so that you do not make the same trade again using the same funds or securities. The next step is order matching and trade execution. Once the exchange receives all the orders, they collate all the buy and sell orders. Then the exchange tries to allot the security to the best available price. Once a match is found, the trade is executed and the exchange sends the notification to the broker, who in turn informs the investor. The last step in executing a trade is clearing and settlement. Once a trade is executed, it goes through the clearing process we discussed before. After the clearing process is complete, the settlement process is executed so that the buyers get the securities credited to their account and the seller receives cash in their account. The entire process is facilitated by the broker, so as far as you are concerned, your broker will be the sole point of contact for you. Bid price is the price a buyer of a security is willing to pay in order to buy the security. Correspondingly, an offer price or ask price is the price a seller of the security is willing to accept in order to part away with the security. As a trader, you will place an order that specifies a bid price or offer price. You will also specify a corresponding bid quantity or offer quantity associated with the price. Before you place an order, you have the option to see a live feed of active orders. Often the brokers provide you with a snapshot of top 5 bid and top 5 offer prices. A sample snapshot is shown here. This here is the best bid price and this here is the best offer price. The best bid available at this time is 179.30 and the best offer available is 179.35. Let's look at a few examples to understand how the execution of an order placed by an investor will work given this bid offer price quantity situation in the market. Now if these are the available bids and offers in the market and you wish to sell 50 shares at 179.30, you can do so by placing a market or limit order. A market order tells the broker that you want to execute your trade at the best available price in the market. So in this case, when you place a market order to sell 50 shares at 179.30, if the order reaches the exchange in time and the market bid offer price quantity does not move, you will be able to sell your 50 shares at a price of 179.30. Similarly, If you wish to buy 50 shares at 179.35 and you place a market order which reaches the exchange in time, you would be able to buy 50 shares at 179.35. Now if instead of placing an order to buy 50 shares, suppose you place a market order to buy 100 shares. In this case, you will be able to buy 50 shares at 179.35 since only 50 shares are available at that price. Another 50 shares would be bought at 179.40 as this is the next best offer available in the market at the time. Some of the basic order types include the market order, the limit order, the stop loss order, and combination orders like the stop loss limit and stop loss market orders. A market order instructs the broker to buy or sell the security at the best price currently available in the market. A market order tells the broker to execute the buy or sell trade irrespective of the price available in the market. If you place a market buy order, it is filled at the lowest available offer price. If you enter a market sell order, then it is filled at the highest available bid price. If the quantity available at the bid price is not sufficient to fill the order, then the remaining quantity is filled at the next highest bid. If the quantity at the next highest bid is also not sufficient, then the next highest bid is hit. This goes on till you get a fill for your entire quantity. So in case of a market order, it is possible that you get fill at different prices depending on the quantity available at various prices in the market. The advantage of market order is that it is virtually guaranteed that your entire order will be executed. The disadvantage is that you cannot be sure at what price your orders will be filled. So for example, if at the time of placing your buy order, you see that the stock is trading at 118.7, it may so happen that by the time your order reaches the exchange, the stock has moved to 119, so you might end up buying the stock at 119 instead of 118.70. So essentially in case of market orders, there is always a risk that the market may move adversely by the time your order reaches the exchange. In order to eliminate the risk, there is the option to place the limit order. In case of limit orders, you are required to specify a limit price and limit quantity. In case of a limit buy order, the broker is instructed to buy the security only if it is possible to get a fill at or below the limit price. Similarly, in case of a limit sell order, the broker sells the security only if it is possible to get a fill at or above the limit price. The advantage of a limit order is that you can be certain about the price at which your order will be filled. The disadvantage is that you can never be sure if your order will be executed. For example, if you want to buy a security at 100, but by the time your order reaches the exchange, the prices go up and do not come back, then your order will not be. The next type of order is the stop loss order. The stop loss order is used to contain your losses on a trade. The stop loss order requires you to mention a stop loss price for your trade. By specifying a stop loss order, you instruct the broker to get you out of the trade if the prices reach the stop loss price. Once the prices reaches the stop loss price, your broker will automatically close your position, thereby limiting your losses. Let's say you are long 100 shares of company A at 20 and you want to exit the trade if prices fall below 18. In such a case, you can place a stop loss order with your broker by specifying the stop loss price at 18. If subsequently the stock's price falls to 18, your stop loss order will be triggered and your broker will get you out of the trade. A stop loss order can again be of two types. These are the stop loss market order and stop loss limit order. A stop loss market order tells the broker that once the stop loss price is hit, the trade should be exited at the best available price in the market, irrespective of whether the price is worse than the stop loss price or not. For example, if for a long trade, you place a stop loss market order at 18 and say there is a rapid decline whereby the prices moves from 18 to 17.8 very fast, your stop loss order will still be executed and you will get a fill at 17.80. By placing a stop loss market order, you can be sure that you will be out of the trade once your stop loss is triggered. But the price at which you get out of the trade is not certain. Stop loss limit order allows you to specify a limit price as well. For example, in case of the long trade, you may place a stop loss limit order with a stop loss price at 18 and limit price at 17.90. This will instruct the broker to get you out of the trade once your stop loss price is hit, as long as he is able to get a fill at or above 17.90. So for example, if prices suddenly move to 17.8 before your order can be executed, then the broker will not sell your stock at 17.80 and would instead wait for prices to come back to at least 17.90 so that he can get you out. In case of stop loss limit order, the price at which you will exit the trade is certain. However, it is not certain that your stop loss order will be executed. This means that there is a chance that you may not exit a losing trade even though your stop loss price is triggered. For this reason, I prefer to use the stop loss market order in my trading. With this, we have covered the basic order types. It is possible that your broker provides you some other order types as well. So in the next video, I am going to cover the different order types provided by my broker so that you get a feel for how different order types might work in real life. So see you in the next video. Welcome back. In this video, I am going to cover the various options to execute your trade. I'll be doing this using the software I use. This software is provided by my broker, Zerodha. I'll cover the options provided by my broker. Now, of course, your broker may provide slightly different options or similar options that go by different names. But once you go through this video, I feel you will get a good understanding of how you would like to execute trades with your broker. So let's get started. This is basically my market screen. Here where I have all those securities that I'm currently tracking. Now here are the different order types that my broker provides. First is a simple buy order, a simple sell order, then I have the bracket order and the cover order. So these are the basic options that my broker provides me to execute trades. We will look at them one by one. I of course assume that you know what is a market order, what is a limit order, or what is a stop loss order. I'm not going to get into that basic stuff here. I'm going to just cover these various options that I have to execute my trades. So let's start with the simple buy order. In case of a simple buy order, you just select the exchange, the product type, select the symbol of the security. In this case, it is Sun Pharma. Because I have selected this on my market screen here, you mention the order type. It may be a limit order, a market order, a stop loss order, or a stop loss market order. Now I assume you know these basic order types. Then you mention the quantity. Let's say I want to buy 100 shares of Sun Pharma, and I basically enter the price. Let's say I want to buy these 100 shares at 520. So you can just press this submit, and if the market is such that you can buy 100 shares at 520, then your order will be executed. This is a simple buy order. Similarly, you have a simple sell order. Again, in this case, what you need to do is basically select your exchange, select your product type, then you select the security name, select the order type. Let's say you select market. Maybe you now want to sell at market price. Select the quantity. Since this is a market order, you will obviously not enter the price because the order will be executed at the current market price. Now you can just press submit and your order will be executed. So this was simple buy and sell order. Now let's look at a different order type, which is one step forward from the simple way of execution. Now let's look at the cover by order. The cover by order takes you one step forward. Again, you will see you have similar options here. You can select the exchange, you can select the security type, and you can select the symbol. You can make this order a limit order or market order. You can mention the quantity. Let's say you want to buy 100 shares and you want to buy at 520. So far it is as simple as in the case of a simple buy order, but in case of cover order, the broker has provided me an option to specify my stop loss price also. So for example, say I want to execute a trade where I want to buy at 520 and I want to get out of this trade in case it goes against me by say 5 points. So let's say I want to get out of this trade at 515. So I can just mention 515 and this will basically instruct my broker to get me out of the trade if the prices fall to 515. Similarly, you have the cover sell order. Basically here too you will mention the exchange, the security type, the symbol, whether you want to place a limit order or market order. You select the quantity, the price, and again you can basically place your stop loss price. Let's say you want to sell these shares at 520. Maybe you want to place a stop loss at 525, and so this will instruct the broker to get you out of the trade if the prices go against you to 525. The advantage of cover order is that it immediately protects you in case the prices go against you. So right at the moment you enter the trade, you also place your stop loss. So this will basically make sure that you get out of the trade if there is adverse development and it goes against you. However, if the prices go in your favor, then you have to manually book your profits because this option type basically does not allow you to mention a target price in this order. So this is where bracket order comes in handy. So now what we are going to do is look at the next order type, which is the bracket order. Here is the bracket order buy. Again you see these are similar fields. You select the exchange, select the security type, select the symbol of the security. You select the quantity. Let's say you want to buy 100 shares of Sun Pharma and let's say you want to do so at price of 520. Now let's say you enter a trade where you go long 100 shares of Sun Pharma at 520 and you want to book your profits if the prices hit 525, and say you want to book a loss if the prices hit 515. So let's see how we can execute this order using the options we have here. This square of cell option here is used to basically mention your target price. In this case, you don't directly mention the target price. Basically, you won't write 525. No, instead you need to write 5 here. That is, you need to mention the number of points your target price is away from your entry price, and the system will automatically calculate your target price. So once you mention 5 here, this tells the broker that your target price is 5 points away from the entry price. Similarly, once you mention 5 here, it will tell the system that your stop loss price is 5 points away from entry price. Now instead of mentioning the absolute number of points, you also have the option to mention the number of ticks. So instead of 5 points, you can mention 100 ticks. Similarly, instead of placing a stop loss sell order and mention 5 points, you may mention 100 ticks. This again will tell the broker that basically the price at which you want to exit your trade if it goes against you is 100 ticks. So this will again come to 515. So basically your broker will know that you want to exit the trade if the prices go 100 ticks in your favor. So again your exit price will be 525. Now I find it easier for me to just directly enter the number of points, where basically I don't want to do the math of multiplying the number of points to the number of ticks. So I usually directly enter the number of points here. So in case of target price, I write 5 points here, and again in case of stop loss also, I place 5 points here. Now apart from this, there is another parameter that you can select for your stop loss and take profit price. This parameter is shown as LTP and ATP here. If you mention LTP, what happens is once your stop loss price is hit, then your broker will get you out of your trade at the best possible price. So for example, in this case, the stop loss is 515, so the broker will get me out of the trade once the stop loss is triggered. So let's say if prices go to 514 suddenly, then the broker will still get me out at 514 if it is not able to get me fills at 515. If you choose the ATP option, the broker will place an order to get you out of your trade at 515. So what happens is if you have a fast move and prices move to 513, then your exit order will still be placed at 515 and your position will still be open. As you know, this can be very risky, which is why I prefer to use LTP and not ATP. So this is how you can place a buy bracket order. Now what will happen is once you enter a trade, you automatically instruct the broker to book a profit at price mentioned by you or book a loss at the stop loss mentioned by you. And once your stop loss price or take profit price is hit, the broker will cancel the other order. So basically, if your stop loss price is hit, then your take profit order will automatically be cancelled. Similarly, if your take profit price is hit, then your profit will be booked and your stop loss order will automatically be cancelled. This is why this bracket order is often also known as OCO order, which stands for one cancels other order. This OCO order is very common in Forex, but this order is nowadays being provided by certain equity brokers also. So I hope your broker also provides this option to you. There is obviously an advantage to using this kind of a system because all you need to do is to be there when you are entering the trade and the system will take care of the rest. Now what happens in case neither your stop loss price nor your take profit price is hit? Well, in that case what happens is that when you are just 10 minutes away from the closing, the broker will close your position at the prevailing price. So for example, let's say in this case we entered a buy order at 520. Let's say neither your take profit nor your stop loss gets triggered, and let's say the prices are trading around 522 just 10 minutes before closing. Then in this case the broker will close the position at 522. So basically once you have entered the trade using bracket order, there is nothing else you need to do and your broker is going to manage the entire trade from here on. Now like you have the bracket buy order, you also have the bracket sell order. Again in this case, let's say your trade becomes sell, you want to sell at 520 and you want to get out of the trade if the trade goes 5 points in your favor or against you. So all you need to do is mention your entry price. You have to select the number of points your target price is away from your entry price, and then you have to select the number of points your stop loss price is away from the entry price. So let's say if your entry price is 520, then placing this order will instruct the broker that your stop loss price is 525 and your take profit price is 515. With this we have covered the various options for you to execute your trade. You might like to use one type or the other depending on what you are comfortable with. I personally prefer to use bracket order because I just need to be there at the time of placing my entry and the broker will take care of the rest. So that's all for this video and I hope you liked it, and now you can move on to the next video. Brokers can be divided into two broad categories. These include the full service brokers and discount brokers. Full service brokers don't just execute transactions, but they also provide a range of services to the customer. Full service brokers also have a dedicated research desk for providing recommendations to the client. They may also provide portfolio management, tax planning, and retirement planning service to the clients for some extra cost. On the other hand, discount brokers mostly deal with executing trades at much lower cost compared to the full service brokers. They generally do not provide any investment advice. If you are new to investing, it is better to stay with a full service broker instead of a discount broker. This will give you a range of investment options. As you gain more knowledge and become comfortable with active trading, you may shift to a discount broker as well, especially if you are looking to day trade markets. But before you select a broker, it is important to do your research. I will now share some factors that you should consider when evaluating brokers. The first and foremost factor you should check is website availability. Since most of the trading is electronic, you should check the availability of the website during peak trading hours. It is important to consider how fast their website responds, especially if you are considering a discount broker. The next factor is alternative trading facilities. This will become an important factor when the broker website is facing outage. In such scenarios, you may want to check if they take your orders over the phone, and if so, do they charge a different brokerage fee for this service. The next factor is customer feedback. You can look for feedback from investing community when you choose a broker. Since existing investors speak from their experience of using different brokers, you could benefit from their feedback. You could search for various discussion forums where you can find reviews from the investing community. The next factor you should look at is minimum deposit requirements. Most brokers would require you to deposit a minimum amount with them. This deposit is available for you to trade. You will find that most of the times the initial deposit requirement is negotiable, especially if you are talking to multiple brokers at the same time. The next factor you should look at is the product you are going to trade. If you are a beginner, you would probably start by trading stocks in cash, but there are also other alternatives for you to trade. For example, after you gain some experience, you may like to trade futures and options on stocks. Usually there is difference in brokerage fee for these products, so you should compare the brokerage fee of different brokerages across products before choosing a broker. Lastly, you may also compare the interest offered by them on your deposit. Most brokers offer some interest on money deposited with them. Since you are probably going to have some deposit with them at any point of time, you should check and compare the interest rate offered by them on your deposit. Algorithmic trading uses mathematics and computer programming to reduce the effect of human emotions and biases in trading. Algorithmic trading is often used for two purposes. The first is to automate order executions for efficiently executing large orders. The second is to place automated trades in order to profit from them. Often the term algorithmic trading is used to refer to automating the order execution, while the term automated trading is used to refer to place trades in order to profit. Automated trading involves automation of the complete trading process. When a new investor asks this question, he often has automated trading in mind, where he wants to profit from using a programmed trading strategy to execute his trades. In order to be effective at automated or algorithmic trading, one needs skills in two domains. First is computer programming, and the other is some amount of knowledge of mathematics or statistics. These skills may or may not be readily present in every individual. Brokers often assist high net worth individuals to execute trades using algorithmic trading, but the same is not true for automated trading. Automated trading requires developing a trading system that applies certain rules to determine the entry price for the trade and also to determine the exit. Before deploying any trading system in the market, one needs to backtest this system using historical data to determine if the trading system has been profitable in the past. This essentially means that the trader may need to create and test multiple trading systems before he comes across a profitable trading system. Even after finding and fine-tuning such a trading system, it is not uncommon to find a system that works well in simulated setting, but it does not work so well when implemented on real-time markets. What is more, even if a trading system works, one needs to continuously monitor these systems when they are operating in the market, as they require manual abort if something goes wrong. As there are multiple tasks that need to be performed in order to be successful in automated trading, it is often best to work in teams instead of individually. Also, automated traders need to adhere to strict guidelines from various exchanges in terms of capital requirement and system requirements, which may be capital intensive in nature. It is not uncommon for stiff penalties to be levied by the exchanges if automated trading firms are found in violation of their rules. Hence, considering the complexities involved in automated trading, it is best for new investors to not immediately indulge in automated trading in individual capacity. In fact, a team setting is probably the best place for any beginner to start with automated trading. So if you are really serious about getting into automated trading, you should do it in teams.